of Indian stock markets. The reason is the companies usually nowadays, if they survive for a decade or something, it's a big task. The reason is now the life cycle of an industry or a business are short-lived. Even 8, 10 years or 12, 15 years, uh, the companies are getting matured very fast. So, and only the bigger names and the better industries, and I would say uh, the entry barriers make the companies currently to survive. So even if you take Reliance Industries as oil refineries, their barrier of entry is very high, so that's the reason they have survived for so long. But even if we see uh, companies in the same management like Reliance Capital or Reliance Communication or other lines, they didn't survive very well. The reason is maybe we know the barrier of entry is not very high. There are a lot of competition, so the margins coming down. So as a business, it is very difficult to survive for a long time. That is one reason. Uh, but since we are analyzing about value stocks, so we should identify is there any scope of picking a small cap stock and then making them as a mid cap, or a penny stock and making them as a small cap or a big cap or a mega cap. So those sort of opportunities, that's the reason I'm making this video, just to make sure. At the same time, the quality of the management is one of the important thing, keeping the numbers aside. So if the quality of management is very high, then the numbers will follow automatically. Even though if it is not in short term, definitely in long term there is an opportunity. That is one thing which we need to strongly believe. Coming back to the context, the company which I am talking about is nothing but Polyspin Exports Limited. So going back to the company, what they do, the company is based out in Rajapalayam, Tamil Nadu. They have established in 1972. Now it's almost 50 years old, 2020. The company became listed in 2010, around 2010. They became a public company. Before that, too, they were a public company, but their company shares were not traded in the stock markets, because in 1972 we don't have online markets, we have the OTC markets. So the share certificates were traded physically. That is one reason. So coming back to the products, what the company manufactures, as you guys see on my screen, their primary business is into container bags, uh, circular bulk bags. So these bags are mainly consumed by industries. So we don't have the exact details who are the end consumers, but the deep dive into their company annual reports will give you a very good idea. Surprisingly, even the certain numbers or the statements have been maintained very well by this company. So no surprise. That's the reason they have came uh, a long way. That is one of the reasons. So these are all the board of directors and the management. Maybe you guys can have a look uh, if you're interested, or if you're going into analysis those time. So now coming back to the numbers, the company is currently valued at 28 crores in the market. Now the current price of the stock is around 70. The company had made a high of 106 and made a low of 56. The stock is currently trading at a PE of 5 times. That is, it seems like they are making annually 15 crores, and annually around, I will not say 15 crores. Uh, uh, they're trading at literally 5 times from their earnings. So the market cap of the company is around 28 crores. The dividend yield is not very significant, but they are paying out consistently from 2010. Not sure whether they are investing in any growth opportunities, but dividend yield is considerably low. One good thing is they are paying out. Coming to the return on capital employed and ROE numbers, we'll see in more detail further, but those numbers seems consistent to me. Coming to the historical numbers, from 2010 they were trading at around 40 to 30, 30 to 40 levels, and then in 2017 they made a high of 140. From there they all the way down to 60 now. So that is one thing. Current year earnings, one worrying thing is current year earnings is contain other income. What is the other income part? I think this other income might came from like for example sale of company's fixed assets, like maybe a buildings or an equipment or any assets or anything other than their current operations. So that 6 crore contains of non-operating income. So what does it mean? So it means that next year the 6 crore won't be there in the balance sheet or profit loss statement. The reason is it's not coming from the business. It's pretty simple. It's not coming from the business. It's not coming from the business which they are doing. It's coming from, if you're selling something and then showing it as another income, that is worrying thing. And significant worrying factor is the promoter has decreased their holdings in last 3 years around 4%. That is significantly one worrying factor. Now going into the peer comparison, there are a lot of companies in this industries, but in order to do a fair comparison, I don't think it's justifiable one to compare a 28 crore company with a 8,000 crore, 1,000 crore. So what we can do is maybe we can take a second last or third last. If you want to do a comparison, we can straightly do that. But I would say uh, we should see the opportunity whether the 20 crore company can become a 200 crore or 300 crore. That is a fair expectations. Even if it's 100 crore, that is a fair expectations. A 28 crore company gaining a market care of 1000 or 2000 crore, it's definitely not a fair expectation over a short term period, because it's almost 50 years now. If they would have made it, they would have made it by now. They didn't, so it's not a fair expectation going further. So giving the current considerations, now this markets are now very badly hit, so it's not a fair expectation anymore. So we can't do the comparisons with uh, any of the other uh, companies listed down here. Now quickly coming to the profit loss numbers. So in March 2010 they made a sales of 35 crores and an expense of 32 crores, and the operating profit of 3, and then made a net of 1 crore. In 2010 they made a net profit of 1 crore, and earnings per share of 2 rupees. So if you buy a share of around their dividend yield is around 80%. So 80% in the sense they're giving you a payout of $1. So a 70 rupees share is gaining you a $1, which is nothing but 1.5% in India. It's not a very attractive number. So dividend yield definitely disappoints. Now coming into the sales growth number, in 2010 they made a sales of 35. In 2020 almost 10 years now, they are around 200 crores. Operating profit have grown, I would say around triple fold, but operating profit margin percentage, this is one of the worrying thing in this industry. The reason is those are very thin line. They need to make a lot of sales to have a bigger number. So for example, now they are making a 200 crore sales and they made a profit of 5 crore. So only if their sales capacity increase by 5 fold or 6 fold, then their net profit numbers can boost up to 25 crores or something. So the company, what I mean is, in order to the company to grow 2 times, 3 times, 4 times, 5 times, their sales number should support. Of course, the sales numbers can support over time because the product prices will rises over time due to inflation. But other worrying factor is if operating margins are very thin, so their bottom line, I mean the net profit numbers will not grow very significantly over time. That is worrying thing. It looks like it's a volume driven business unless and until they have a very good volume either in contract terms or a business terms. uh, it is very difficult for the company to have a very high turnaround. But at the same time, since it's a long established business, um, they might know the nook and corners. That is one thing we should take into guarantee. They know the risks, so we never know. So we never know, since investing is almost like an option. So we have taking a calculated risk if we want to take anything as of now. Coming to the component sales growth, the sales growth is growing around 16% annually, at the same time 18% profit growth, not bad. And coming to the share capital, it's a 4 crore capital, very consistent, and they borrowed. The trade payables is around 10 crores, obvious, so it's a morely into the textile industry, so of course the trade payables will always be there. The company fixed assets, looking at the fixed asset numbers, equipments around 70 crores, not bad. Inventories, okay, inventories now is around 24 crores. So you would have seen the sales is around 166 crores for an year. Now, they have an inventory of 26 crores as of March 2020. Not bad, maybe to meet the immediate obligations, but I'm not sure whether they have met, whether they got any contracts, whether they have fulfilled the contracts due to the current COVID scenarios. Even the trade receivables, the 25 crores trade receivables, whether they will be collecting, that is a very question mark. The cash equivalents, it looks good. We can see the borrowing is around 61 crores, and out of that they are having around I would say 10 to 15% of cash. Not bad, not bad, but uh, only variable thing is the trade receivables part. The 25 crore or the 24 crore company, but at the same time they need to pay around 16 crores. Whether there will be any haircut on the trade receivables, because the company's overall market cap is around what? It's around 28 crores. So if they're not receiving the receivables, we are gone. So we don't have any buffer. So that is one thing. But giving the benefit of doubt to the management, because in penny stock, what we can expect from penny stock? So uh, the business is established for a long time. So that is one thing which we have in our side. So operations is happening. It's good. Investing, it seems like they are investing something around 15 crore outflow happened in 2019 and 10 crore in 2020. Not at all bad. But net cash flows, they're not able to generate net cash flows. That is significantly worrying thing. Only if they generate the cash flows numbers, they can contribute to uh, the retained earnings, or only the equity shareholders, then only the equity shareholders can gain. So the cash flows is one thing pretty disappointing. And one of the worrying thing which I would say is the promoter holdings significantly came down. I would say not very significant, but it came down from major shareholding to minor. Why? So the reason is in 2017 and September 2017, that's the period. If you see in 2017, uh, their shareholding is, the company is a major company. They're holding a shareholding of 51%. But if you see the historical share price in 2017, if you see, they made an all-time around high of around 120 and 140. So that's the range where these promoters have exited their holdings. So from 2017, we have seen they've exited their holdings. That means they've sold their stock. Nothing wrong in that, because they might be holded for 30, 40 years for a company. So nothing wrong in that. They might have exited around 120, 140 levels. But at the same time, what we have to look into is after March 2018, whether there is any increase in promoter holdings. Yes, it seems like it's been increasing around 2% or 5%, whichever way it is. Probably to coming back before we conclude, the observation is the industry is now currently vulnerable to the export import regimes. That is one. So their profit levels will come down, their trade receivable numbers will come down. Of course, that will translate, that will affect the profit levels for at least 1 to 3 years down the line. So what happens is, so which literally brings down the pressure on the stock prices and also on the management. At the same time, one good thing is, once this things turn around, I would say, since these are penny stock, uh, we never know, we might get it for even 20, 30, 1 2 years, around a 1 year time frame from now. So buying, that's the time where the management, the promoters also get into those prices, assuming. So those areas are attractive, because what I would say is, Since these are penny stock, only advantage which we have on our side is the nature of business and the management and the quality of management. Once that is there, what we are betting more on the management than on the company and the business itself. That is one thing. So giving all that to the fact, to conclude, a diligent approach is required, but investing at current levels, I would say it's morely like a speculating thing. But anything at if you get around the price to earnings of one time around 20-30 levels, uh, it's an attractive bet, maybe for a 5-6 years, uh, years down the line. So maybe they might have come down. The reason is they would have seen a lot of recessions. It's almost 5 decades, right? So 5 decades, they would have a lot of recessions. If they would have failed, they would have failed long back. That is one thing. Since this business are not very high debt, so we should give benefit of doubt to that factor too. Uh, so okay. Uh, thanks all. Thanks for watching. So maybe I'll come up with a new video on an interesting stock next time. Thank you.